Welcome to the Allan Small Financial Show. As always, I'd like to thank everyone for taking a busy day and spending it with us. I know many of you are running around doing that last-minute shopping right before the holiday. The weather is cooperating here in Toronto, a nice sunny day, although we're expecting some rough weather. I think most of the Southern Ontario region expecting some rough weather in the coming few days. But right now, everything looks great. And I'm sure everyone is happy, getting excited for the holidays, the kids getting ready for those gifts. So again, thank you for spending some time with us during this busy time of year. We have a great show coming up, a great lineup. And again, we do these shows to try and bring information to all of you so that you can understand what's going on with business, what's going on with finance, what's going on with your portfolio, trying to answer the questions that you may have with regards to what's going on in this crazy volatile world that we live in, and how does that affect your investment portfolio, your retirement plan, etc. So we bring these shows to all of you so that you can ask me those questions. What's going on? And hopefully I have some answers to share with you. So without further ado, on with the show. So today's show, we have a fantastic guest. Stephen Crawford is here. He is the assistant to the Honourable Peter Bethlenfalvy, Minister of Finance of Ontario. He'll talk to us a bit about what's going on in Ontario right now, how our small and big business coping with what's going on. Obviously, inflation, higher interest rates. We'll get into all that with Stephen. And then we have our usual This Week segment. What do I think is important for individual investors to consider over the next couple of weeks when they make their investment decisions? We're going to talk a bit about how the year 2022 has gone. A bit of a look back. This is our last show in 2022, so I thought it would be a good idea to talk a bit about the highs and lows, what surprised me, and obviously the next topic, what to look forward to in 2023. What are investors saying? What are the analysts saying? Economists, etc. We'll touch on that. And last two topics, we're going to get into a little bit of the oil trade. Price of oil has sunk all the way down to the low 70s, although today I see it's creeping back up into the high 70s again. We'll talk a bit about oil and oil price. And lastly, cryptocurrency, something that we touch on every now and again on the show, but it's been in the news a lot lately with the, the bankruptcy of a company called FTX, crypto exchange. We've been seeing the name Sam Bankman-Fried in the news. What's going on over there? And is this going to affect the price of Bitcoin, for example? So that is our lineup, and looking forward to getting on with the show. So I'd like to welcome Stephen Crawford, Parliamentary Assistant to Ontario Finance Minister Peter Bethlenfalvy. Today we'll talk a bit about the Ontario government's focus on the economy. Stephen has been an MPP representing Oakville since 2018. Prior to that, he worked in the financial industry, including senior equity partner of Acuity Funds. I'd like to welcome to the show Stephen Crawford. Thanks for being here, Stephen.
Thanks, my pleasure, Alan. It's great to be here.
Excellent, excellent. And as we spoke about a little earlier, I like to kind of have an informal conversation about what's going on in Ontario, business and the economy. And I thought I'd just start off by asking you the question. I noticed that you recently spoke to the Oakville Chamber of Commerce about the economy and creating a positive environment for businesses to flourish. What's your view on the state of business in Ontario? Talking to Dan Kelly at CFIB, he was a guest on the show a few months back. He says that businesses have never really fully, since the pandemic or coming out of the pandemic. What's your take? How are businesses doing, in your opinion, right now?
Well, I think overall businesses are actually doing very, very well. Now, he is correct in that there are certain sectors of the economy that have not fully recovered from COVID. I would highlight those as being more in the hospitality and tourist areas. But aside from that, I would say overall businesses are doing very, very well. And we have a shortage, Alan, in Ontario of over 300,000 workers. We need workers here. That's the biggest problem because demand has been so high and employers just can't find enough people to hire. Notwithstanding that, like I mentioned, there are pockets that haven't fully recovered, those specifically being, I would say, more focused in hospitality and tourism. And we've put out supports to help those particular businesses. For example, even in the restaurant sector, which was definitely hit very hard, as we know, through COVID. Recently, in this last year, the government announced that restaurants would be able to just alcohol at a 20% to pay at the LCBO. So for all in the past, restaurants would pay the same price that you would for a bottle of wine, for example. They're able to mark up more on some of the wine, which definitely helps their bottom line and helps those businesses. So we're trying to do what we can, but overall, I would say the state of the Ontario economy and businesses is pretty strong.
So is that why you think the Bank of Canada has been so aggressive in raising interest rates? Obviously, they're raising interest rates to combat inflation. What do you think of that and their policy of this aggressive interest rate hikes? And what is government prepared to do to help businesses? Obviously, they have a lot of debt on the books, and when Bank of Canada raising times this year, that's definitely going to handcuff a lot of these businesses. What's your take on that?
Yeah, no, you're absolutely right. And at the end of the day, that the interest rates is trying to push down was really created as an anomaly coming from COVID. Because with COVID, we had people sitting home for a year, 18 months, and they were saving money. And after COVID and things opened up, demand for basically everything went up so high that there became this imbalance in supply and demand, pushing prices up. Obviously, there were also supply chain issues as a result of COVID. So inflation has been pushed up by these issues. And it's not for me to suggest, what the Bank of Canada does as a government official. I mean, neither federal or provincial government has jurisdiction. The Bank of Canada is independent. But having said that, I think we do need to get inflation under control. There's no doubt about that. I think likely that it'll be a short-term phenomenon. And these rate increases May 2023. Now, clearly, they are hurting some businesses in the short term, and they are hurting demand in the short term. And they're certainly, I say the area most affected is probably housing, where it's pushing the cost to borrow to go up. So with that, I think it's having the intended effect. We are seeing a bit of a slowdown, but we don't foresee any dramatic slowdown. We think the underlying fundamentals of the Canadian, and particularly the Ontario economy, are very, very sound. So we'll withstand a bit of this turbulence, which we're still in the midst of right now, but we think we'll come out very, very strong.
Right. And you mentioned labor, for example, labor shortage, trying to get more workers, et cetera. Brings a question to mind for me, because Bank of Canada, Federal Reserve in the US, they're talking about wage inflation. They're talking about, trying to bring down wage inflation. And one of the things that many people are saying is that the unemployment rate will probably have to rise before we start to see a measurable decrease in inflation. But at the same time, as you mentioned, government is trying to hire more, create more jobs, pay people more. So it kind of is a bit of odds with what these central banks are talking about. And so someone like myself, when I hear central banks talk about wage inflation and trying to slow things down, and then I hear the government talk about how you want to create more jobs and pay people more, which is great. How do we balance those two things? They seem to be at odds with each other. It's very difficult.
Yeah, no, that's a very good point, Allan. You're very astute in that, in noticing that. And, it's our view, again, here at the Government of Ontario, that we do want to create jobs. And I think that we believe that inflation can come down without a protracted period of higher unemployment. We think actually getting people into the workforce, those that left the workforce for whatever reason after COVID, perhaps people that may typically want to get back in the workforce, younger people, students, we think it's great to encourage them into the workforce, and we think that'll have a positive effect. And we don't believe that in itself will drive up inflation. We just need to get this supply-demand imbalance sorted out, get the supply chain issues sorted out, which they are. And, we believe they more than likely will be in the first half of 2023. So I think the overall outlook, as I mentioned, is still very positive, notwithstanding a little bit of turbulence in the short run, but the fundamentals are strong. We are seeing incredible investment in Ontario that we in decades. In the previous 2 decades, over 300,000 manufacturing jobs left Ontario, for example. In fact, the previous government really did not put an emphasis on manufacturing. In fact, entirely it was on service jobs. They felt manufacturing jobs were a thing of the past. Nothing could be further from the truth. We are seeing a manufacturing renaissance in Ontario with automobile manufacturers, battery manufacturers, medical supply chain companies coming back and building further in Ontario, whether it be electric vehicles or others. But the point is, manufacturing is undergoing a renaissance here in Ontario. So we think the outlook underneath this short-term turbulence is very strong.
So it sounds like you're in the soft landing camp, I guess. And so I guess my last question to you is, heading into 2023, we've heard the Bank of Canada talk about the R word, right? A possible recession. It's kind of a 50-50 whether we dip into recession the first 2 quarters of next year. What do you think of that? You think a recession is in the cards? And if it is, what is the Ontario government prepared to do to help these businesses weather a possible first half of the year recession?
Yeah, no, that's a very good question. And, hard to say, obviously, whether there will be a technical recession or not. We know there's turbulence. I think there's a general agreement about that. We have seen a slowdown in demand for many different products, which may not be a bad thing. Again, to get that balance in play, we think that we're in for a bit of turbulence, but we believe that we will, as a government, have a deficit next year, albeit not as large as it has been over the last few years. In fact, we had a budget surplus the last year, which was an unexpected surprise, and that was really, again, driven by that high post-COVID demand. Now, in terms of what we're doing for individuals to get through a little bit of this turbulent times, a few things we've done are, for example, ODSP, which is people on disability supports. We've put an increase through for 5% on that, and also indexed it to inflation for the first time. That's going to help some of our most vulnerable people here in Ontario. We've also reduced the gas tax for an extension for another year. That's 5.7 cents at the liter. So you've noticed that Ontario gas prices have come down. Now, some of that is, of course, due to the supply and demand and overall prices globally, but the government of Ontario also reducing the tax further cut that. We were also able to remove the tolls on the 412, 418 out in the east part of the GTA, and we've eliminated the license stickers, which is saving a lot of people significant sums of money, both businesses and individuals. So we're trying to help Ontario families weather the short-term turbulence.
That's great. It's always good to hear what government is doing. Sometimes we get a chance to see it on TV and hear it in the news, but it's great to have you on today. Thank you so much for being here, MPP Stephen Crawford, giving us a glimpse as to how government is thinking, a bit of an idea as to what you're expecting in the future. So I want to thank you to coming on again today. Happy holidays. Hope you get a chance to enjoy some holiday time with family and friends. And I wish you all the best, and perhaps we'll chat soon down the road.
Would love to, Allan. All the best to you and for the holidays, and to all your viewers. Have a wonderful holiday season.
Thank you so much. Take care.
Thanks. Bye.
So this is the part of the show where I talk about what I believe individual investors should be focused on when they make their investment decisions over the next few weeks. We're going to touch a bit upon economic data. It seems like we're always talking about economic data that comes out, and how to think about it and what it can mean for your investing. Corporate earnings. Corporate earnings season is about to start up again in in a few weeks. And what are corporations saying, and how is that going to affect your investments? And lastly, and perhaps maybe this should be actually at the top of the list rather than the third point, is investing or paying down debt. I've had a number of questions asked of me recently, and those were with interest rates rising and obviously interest or the cost of carrying debt rising. Should you be paying down debt at this time versus investing, or a bit of both? Or should you just be investing and not worrying about the debt? So we'll touch a bit upon that. But let's take a look at the economic data, shall we? And we have a few charts here that we could show. A chart on Canadian inflation. Obviously, we got some numbers recently today. Inflation rate dropped to 6.8% from not a big fall, obviously well above the target rate of 2% by the Bank of Canada. Recently, we saw the U.S. inflation rate as well to just above 7%. Again, down from its high of, I guess, earlier in the year of over 9%, but still nowhere near the target of 2% by the Fed. So we got to keep an eye on the inflation. The other, I think, is going to be really important, and something that I think the Fed, especially Bank of Canada, but more so the Fed even, is focusing on is the unemployment rate. And I think we have some unemployment data as well. A chart here, Canadian unemployment, you can see has been falling significantly. Many believe that start to rise, maybe 1%, maybe 2%, maybe 1.5% higher from where it is today before we start to see inflation really falling. And it's interesting when we talk about economic data, what we always say is, good news on the economy tends to be bad news, and bad news tends to be good news. What I mean by that is any strong data, strong retail sales, strong economic data in general tends to give the Federal Reserve and Bank of Canada the cover to be able to continue to raise rates aggressively. And when we have weaker data, whether it be retail sales or consumer confidence numbers or anything on the weak side, that tells everybody, well, maybe the Fed and Bank of Canada are closer to the end of their interest rate hike. So economic data is very important for everyone to consider before they make their investment decisions. The second point that I had up there on that list is corporate earnings, or what corporations are saying. And the market has been extremely volatile this year. We've had quite a bit of ups and downs. I think I guess my takeaway from what I hear corporations and CEOs of those corporations, what they're saying right now, what they're speaking about is this idea that things are slowing down. There is no doubt, there's no denying the fact that business is slowing. How much is it slowing? That is the question. We just received good corporate earnings last night out of Nike. Nike seems to be taking up expectations going forward. The reopening of China really helps Nike, a lot of business in the Asian area. So that is one stock or one company that actually had a positive situation or earnings outlook going forward. But many more have definitely had negative earnings outlooks. We're going to hear from Micron, a chip maker, tonight, what they're going to say. That's going to go a long way to see how tech performs in tomorrow's market. So I think corporate earnings season, especially the retailers even, coming out of, the Christmas and the holiday shopping, the Thanksgiving shopping over this past quarter, how are companies faring and are they continuing to sell and make money? So corporate earnings is a big one and a key one as well. And lastly, but as I said, perhaps not least, and maybe even something we should have looked at initially in our list or had it first, is this idea of paying down debt versus investing. And I think we have a chart on that, Canadian interest rates. You see it moving significantly higher, I think, along with the U.S. interest rates. We have a chart on that, I believe. There it is. And you can see how rapidly interest rates have moved. And as MPP Stephen Crawford just said, that one of the industries or sectors affected by higher interest rates is the real estate market. As we all can imagine, which right now is a lot more expensive than it used to be. You would have to qualify for a mortgage somewhere around 7% today, maybe closer to 8% to get a mortgage of possibly 6-ish right now. I know some very mortgages were 1-2% at the start of their significantly higher, over 4%. So paying down debt versus investing, I think it's all going to come down to what that interest rate is on your line of credit or what that interest rate is on your variable rate mortgage. And can you pay some of that down? I think if it's a high rate of interest, yeah, you should look to pay down some of that debt. I would say right now, in talking to individuals, for the most part, I think it's a good balance. If you can pay down some debt and invest at the same time, I think that striking that makes a lot of sense to me. Whereas maybe about a year ago, it was put as much money into investing as you can because money was free at that time. Interest rates were bottom. Today, it's kind of moving into that 50-50, or maybe even paying debt down faster or more towards debt than investing a little bit more. But I still think you need to be an investor. I think you still need to take advantage of what's happening today, which are, stocks and investments on sale. So I think going forward, having a strategy of doing a bit of both makes a lot of sense to me. So the highs and lows of 2022, when I look back over the year that just was, and I know we have a chart, you can put it up, of the S&P 500 index, you'll see the ups and downs of the market. I guess the first thing that comes to mind, and really probably the only thing that comes to mind, unfortunately, are 7 interest rate increases by the Fed, by the Bank of Canada. Something we hadn't seen really since the 80s. So we're talking 40 years since we've seen interest rates move as aggressively to the upside as we've seen this year. And you can see by this chart, the S&P 500, the largest index in North America, 500 names. And you can see the peaks and valleys have been pretty significant there. Unfortunately, you're looking at the chart going from the top left to a bit of the bottom right. We'd love to see it go from the bottom left to the top right. So this just means that, yeah, the S&P is down for the year. I think it's down from the highs somewhere around 20% right now. So yes, it's been a tough go for the average investor. To me, the surprise has been the 7 times. At the start of the year, it was interesting because the Bank of Canada and the Federal Reserve did not anticipate or didn't communicate the fact that they would be raising interest rates 7 times. And, some of the Fed officials actually made comments that maybe they would have to increase 1% this year. Turns out they've increased over 4% this year. So I don't even think Fed officials knew what they were going to do, when the year started. And I guess the data has taken them to where we are today. Inflation has been stubbornly high. It's forced the Fed to continue to raise interest rates. I've said plenty of times on this show, I don't agree with what they've done. I think we need to attack the supply side. And I know MPP Crawford said that as well. The supply chain's loosening up and things getting better there will help inflation. I agree with that. And I think if we, slow down the pace of interest rate hikes, at least at this point in time, I think the market can gain some traction heading into next year. And so overall, to me, I may not have been in agreement with what the Bank of Canada and Fed has done this past year, how rapidly they took interest rates higher. But I'm still positive for the future. I believe the market has fast interest rate increases at this point in time. And if we don't see any further increases in the short term or any surprises, I think the market will be just fine. So overall, I think 2022 is going to be remembered for the interest rate increases, for the inflation rate, for really something we hadn't seen since the 1980s, over 40 years of investing. So let's talk about 2023. So with 2022 almost in our rearview mirror, individual investors or analysts or economists or whomever you talk to, so pessimistic going into 2023, at least for the start of 2023, maybe the first couple of quarters. As I mentioned to MPP Crawford, the talk is about a recession in the first half of next year, and how will that affect our portfolios or investing? And the answer that I get when talking to a lot of people is that most believe things are slowing down. As I mentioned, CEOs are saying that business is slowing down. Well, if businesses are slowing down, that means they're going to be earning less money. Most of the time, for most investors, we look at the PE ratio, price of the stock or the investment versus how much money it's earning, the earnings. If earnings are dropping, then people aren't going to be prepared to pay as much for the stock as if their earnings were rising. So the thought right now is that heading into 2023, as we see earnings fall further and further or get less and less, the stock price will have to follow. And we could see perhaps an earnings recession in the first couple of quarters of next year. And so that has really spooked a lot of investors, and why many are at least negative for the start of the year. I'm a little bit different. I like to look out a little bit further. I know, the market has a forward-looking approach. The market factors in what's happened in the past, and basically the market will move based on what it sees 6 to 12 months in advance. So, if you remember March 2020, when COVID hit and everyone was locked up in their homes, unfortunately, shortly thereafter, the market began to move higher. And everybody was asking, Alan, how can the markets move higher if everybody is not working, if we're all at home? And the answer was the market was anticipating a better environment ahead. Vaccines, people getting back to work, people spending money and getting out of their homes. And so the market started to move in advance of the economy. And I think we're going to see that in 2023. I think we're going to see the stock market move in advance of the economy. So if the economy is struggling the first maybe quarter or two of 2023, I think we'll see the stock market move in advance of the economy once again, and we will have a half of the year. But I think you can start to see, and it is possible to start to see the stock market move higher gradually, even in the first half of the year, if it's anticipating a good second half or a better second half. And that's what I believe is going to happen. So 2023 may be a little bit bumpy as we enter into it, but I think when we come out of it at the end of next year, I think a lot of investors will be in a more positive situation and have better results than what we had this year. And listen, the second half of 2022 has been a positive second half, but I think 2023 should be better for investors. And I just like to look at the glass half full rather than half empty. Wanted to touch a bit upon oil prices. We've seen the prices at the pumps, skyrocket for us here in the Toronto area. And then recently we've seen them pull back again. And the talk was that with the Russia-Ukraine war happening and ongoing, that places like Europe and North America even, we would see the price of oil skyrocket. And we have seen the price of oil skyrocket. But one thing that I don't think the rest of the world or Russia or anybody expected was a significant slowdown out of China. China, with their zero COVID policies that have been put in place or have been in place for quite some time, and now they're starting to relax it again, really started to dampen the demand for oil. China is the largest importer of energy or oil in the world. And so when their economy is shut down and are slowing down, they don't need as much oil imports to their country. And so I believe that has had a major impact on oil. So even though there may be a shortage of energy, natural gas, and oil in Europe, that has been balanced off by a slowing demand. And so instead of seeing oil prices at 120, which they touched briefly earlier this year, we're seeing prices get down to as low as $71 a barrel WTI. And I think we have a chart, an oil chart there, light crude oil. We can pull that up. There it is. You can see how price of oil has definitely slid off with this whole idea of slowing down. Well, recently, I guess in the last couple of weeks, China has announced a softening of restrictions. The zero COVID policy, I don't think, is really holding up well in China. We've seen a lot of people take to the streets and protest, and I think the Chinese government has listened. And China has now come back online once again, maybe not fully, but gradually coming back online. And it is no surprise to me that we're seeing the price of oil, I believe it touched $77, $78 earlier today, this morning. And I anticipate as China online and as we get into a bit of the colder months, January and February of the upcoming 2023 winter season, I believe oil prices will move higher. And I think you could see oil back in the 90s once again. I think if you're owning oil stocks, I think that's going to bode well for them. But make no mistake, oil stocks is definitely something that's extremely volatile. So if you're in those types of names that are in the oil sector, you need to definitely be prepared for high risk, high volatility, because I think 2023 will be similar to 2022 with respect to volatility in the oil sector. So I think a good investment idea, the price of oil will start to or continue to edge higher. I think that will benefit oil stocks. Definitely be careful because these oil stocks are on the higher risk side of things for the most part. Many of them pay great dividends, which is a fantastic investment, but just be prepared for a higher or more volatility in the future. Cryptocurrencies, it's something more and more we're talking about again. With the recent bankruptcy of FTX, a crypto exchange, many people are talking about the name Sam Bankman-Fried, the former CEO of FTX, and now, unfortunately, looks like the former CEO is headed to trial and perhaps some jail time. So a lot of people talking about it. We've seen it in the news. Cryptocurrencies, a lot of people wondering, is this something that's here to stay or is it going to disappear? My opinion, very briefly, is I think the whole notion of cryptocurrency or crypto in general is here to stay. I have always said that. Bitcoin trading in that $16,000, $17,000 US dollar range. Once upon a time was 60,000. I remember it when it was just 1,000 or even lower. And there it is, Bitcoin trading down by quite a bit. I think it's here to stay. I think the technology behind it, blockchain is definitely here to stay. And I'm just not sure it's being more and more regulated by different governing bodies, but not sure in what capacity or what role cryptocurrency will play in the future. Obviously, today it's not being backed by any government or any financial institution. I know many financial institutions have investment options, but when those CEOs speak, the CEOs of some of the largest banks speak about crypto, they tend to speak negatively about it. So as an investment, for those of you that own some crypto or crypto funds or crypto-based ETFs, you may long-term if you like. Obviously, many of those positions are in a negative position right now. You may want to take some losses to offset some gains in some of those positions. But overall, I think crypto is here to stay. And I think that's important. Marijuana sector in 2017, there are definitely going to be winners and losers. But I think overall, the crypto and the technology behind it is something that I think it will be valuable going forward. So, don't panic. I don't think it's something for the average investor to get involved in. It's high risk. But as I said, I think it's something that it will be around and you will hear about it for many years to come. So now's the part of the show where I like to take questions from all of you, all the people watching. What type of questions do you have? What's on your mind? Do you have any specific questions regarding portfolios or questions in general? And I think we have time to take just a couple of questions today. The show ran a little longer. First one I'm looking at here that came in recently. Is an RSP always a good idea if I'm going to be in the higher tax bracket from interest income from my current investments in my retirement? Does an RSP still make sense? Is the point of an RSP to withdraw money or in a lower tax bracket later on, TFSA instead? So yeah, a lot of people today invest in RSPs now, mainly for the tax deduction. As I say to many people, if you don't need a tax deduction, tax-free savings account, because you still get that tax-free growth and you get to pull money out. And when you do that out of your tax-free savings account, it's not taxable. RSPs are great because when you put money in, you get to write off that contribution against your annual income tax. But the negative is when you pull that money out later on in life, you will be have to pay income tax on the amount of money you pull out of your RSP or RIF account when RSPs turn into a RIF at age 72. So RRSPs are not for everyone. It'll just depend on your personal circumstance. And many people today base whether they're going to buy an RSP or put money into an RSP based on if they need a tax deduction or not. I guess a last question I'll take here. I know there's a few, so I'll try and answer the rest perhaps on the next show. Do you ESPs? When is the deadline? Can you please explain how they work and are they a good idea? So RESPs are the best way to save for your child's post-secondary education. The deadline for them is calendar year, but if you don't contribute, you can always catch up in the next year. The government will give you a 20% grant on the money that you contribute up to the first $2,500, up to a maximum of $7,200 for the life of the plan, or per child for the life of the plan. So government grants, your money grows tax-free. These are two great things for get involved in, especially if you're looking to save for your child's post-secondary. So after high school, when they go to a college or university, or wherever they go, if you want to set aside some money, it's definitely a great idea to put money into an RESP and get that grant from the government, because it's free money, 20% free. Don't often get anything free in life. Getting 20% free on the amount of money you contribute to your RESP is a great idea. So with that, I'm going to end today's show. I want to wish everybody a happy holidays, a happy new year. We are off now into the new year. I believe our next show is going to be on January the 11th, which is a Wednesday, as always, same time, same place. And again, thank you for joining today, and all the best for a happy and healthy new year.